So just to give everybody a backdrop, our goal is going to be to really figure out how you can implement the strategy, the questions you should be asking along the way, and to give everybody at least a basic level of understanding so that when you're working with the right professionals, you can ask intelligent questions and actually understand what they're saying back to you. Rather than, I think the biggest mistake a lot of people make is they see an investment, they see an idea, a strategy, they learn a basic level. They go, oh, it's good, right? Some sort of salesperson says, yeah, it's good, and then they start doing it, find out issues later on. The first thing I think you guys need to do is you need to really dive into your why. It's a huge piece of it because with any strategy that involves investing and particularly leverage, there's going to be good times and bad times. So whether it's rule changes in the industry, mortgage lending changes, interest rates go up, values do really poor for your investments or your returns are not good, or just you have life issues, whether it's divorce, illness, job change, your why is going to be the kind of the light at the end of the tunnel, the guiding light that keeps you moving in the right direction and lets you push through those challenging times. So that's my wife and my daughter. I've got a 5-month-old son now too, who's not in the photo, but that's my why. Everything I do at the first level revolves around them. Then as I go further into it, my own retirement, I hope that I can support them and help them. Second goal is I don't have to work till I die. Third goal is to help out my kind of extended family. And then fourth goal for me personally is create transition housing for drug addicts to basically get off the street and get them back into the real world, because rehab sucks and it doesn't do a very good job. But I think it's really important that if you're going to use the Smith maneuver, you figure out your why as well. It's great that you want more money, but what's the money for? And the number one question that you need to ask yourself is, if you do nothing different, no Smith maneuver, no new investing, whatever it may be, if you just keep doing what you're doing, will you reach your goals? Will you be able to take care of your family? And to answer that question, you need to know what those goals are. If the answer is yes, life will be good, don't do the Smith maneuver. If you don't need the money and it's not going to make any additional benefit for you, what's the point of more money? But if the answer is no, and you're going to have to compromise, then I think it's worth looking into different options to figure out what you can do to improve the quality of your retirement. So the first thing that you need to know when it comes to Smith maneuver is the fundamentals of it. The goal is to eliminate your non-tax deductible debt, to maximize your tax deductions, and to let you invest sooner so you benefit from compound interest and you end up with a larger net worth when you retire. This can be optimized for net worth or cash flow depending on how you invest. But the goal of it is to make sure that in 20 years you have more money. Biggest thing you need to know is the strategy takes 8 years, 10 years, 15 years. I don't know, the longer the better. If your goal is you need some sort of result in 2 or 3 years, it's generally not a good choice for you because it does involve investing and there is risk. The goal is to work with professionals to bring that risk as low as possible, but it's always there. So it's a balancing act. And one of the things you can do to protect yourself is to have a longer time horizon. The biggest thing you need to do is make sure that you've got the right people. The number one mistake that I see people make when they're implementing the Smith maneuver is they DIY it. They go online, they Google, they're on Reddit, whatever it may be, take what may be right or wrong advice, but certainly applies to someone else. And they go, oh, that must be true for me too. But they don't know how the title is structured on their home. They don't know if their taxation status is different. Do they or someone else have US citizenship? All of these things matter. By pulling in a mortgage broker, a financial advisor, an accountant, and a lawyer, you can generally cover all your bases and make sure that if there is a landmine out there, you're going to know about it. And if you know about it, then you can worry about avoiding it. I think the biggest question that I get personally is, Keaton, it's great. I get that there's benefits. I get that it can help me build a better retirement, but how exactly does it work? I think the important thing to know is how the money flows. It's the first thing. So I've got a little bit of redundancy built in here because this is a very common sticking point, and I think everybody learns a little differently. The way the money flows is it comes from your personal checking account, and then you pay your mortgage. It advances to your HELOC. You then borrow off it, put it into your Smith Maneuver checking account. Then you invest it, and you make your payments on your HELOC. This may not be super simple, but I want to show it another way. So we've got 4 steps that are involved. What you need to do is at the bottom, first and foremost, you make your mortgage payment. Second thing you do is you draw off the HELOC and you put it in your Smith Maneuver checking account. Third thing you do is you make sure the bank gets their money, because if they don't get their money, you're going to have all sorts of issues. The last thing you do is you invest. It's important that you make sure your investments are right, but at the end of the day, we can boil it down to those simple 4 steps. So now this is more of a visual of how it flows. So this is for certain lenders, not all, but this is most of your banks. Scotiabank, BMO, RBC, CIBC, MCAP, TD, they all operate like this. So your income goes in your personal checking account, then you make your mortgage payment. Your mortgage payment goes to a portion of interest that's non-tax deductible. The bank takes it. The other portion goes to paying down the debt or the principal. With the right mortgage product, as the principal gets paid down, as your mortgage gets smaller, your home equity line of credit gets larger. We then use that growth in line of credit to reborrow. We put it into our Smith Manoeuvre checking account, which is just a fancy way to say it's a checking account that is only used for 2 things, and that is investing and paying the interest on that HELOC you're using for investing. It's important to also know how the money flows. So we're going to go through it another way. So this is just the numbers. For those of you that are super analytical and pictures don't work well for you, this is kind of the dollars and cents. You make your mortgage payment, $26.68, you pay some interest, you pay some principal. Your mortgage balance drops, your HELOC limit goes up. Second month, you do the same thing. You're making your mortgage payment each month. So this is what that first step looks like. Your HELOC limit's going up as you pay down your mortgage. You will notice that the principal you pay off every month is increasing. And I've got a little tip for everyone here. If you're in an adjustable rate mortgage, you have to be a little bit more careful. So that's a variable product. There's 2 types of variable products. An adjustable rate mortgage, where as rates rise or fall, your payment will adjust up or down. Generally speaking, the adjustable rate mortgage is relatively safe, but you still got to keep an eye on it. The other one that gets a lot of people in trouble is the one that you've probably read about a lot, and that's a variable rate mortgage. It has a fixed payment, but floating interest rate. So that means that the interest and principal portions will shift as rates rise or fall. If interest rates go up, then this component shrinks. And if interest rates go down, then this piece gets bigger. Hypothetically, you take a variable rate mortgage today and interest rates drop, it can really accelerate the strategy because it's forcing prepayment. But the thing you have to be careful of is that if interest rates go up, it can blow all of this up and you got to get ready to start dipping into your own pocket. This is the first steps. The next thing that you need to know, the borrowing step. That's step 2. So every month you've made your mortgage payments, your HELOC limits become available, you borrow whatever the increase on the HELOC is. That increases your HELOC balance, and then you move the money over to your Smith Manoeuvre checking account. Next month, a little more money available, you borrow a little more, and then you're reinvesting as you go. Piece of the redundancy is paying your HELOC. So the first month, you're going to owe no interest because it's the first month. You've owed nothing for the first 30 days. They look back, okay, next month you owe $3.64. So what you're going to do is you're going to pay that $3.64. It's going to go from your Smith Manoeuvre checking account back to your HELOC you're using for investing. The last piece is you invest the money. So you take it, you put it into your investment account, you throw it in an S&P 500 index or whatever it may be. If you're a real estate investor and you're building up down payment, you're not going to draw on the home equity line of credit. You're going to let the room grow until you have enough funds to go and invest. So you'll notice every month the Smith Manoeuvre checking account balance stays the same because the money goes in, it goes up, then you pay the payment and you invest, bringing it back down to 2,000, which I've said is kind of the zero, just to give you some float. In case for whatever reason there's a glitch, you've got some money to make your payments. I think one of the strategies that you guys may be interested in, that a lot of you watching this are real estate investors or interested in real estate investing, is cash damming. Cash damming works the exact same as the normal Smith Maneuver, but added on top of it, you are drawing money out of the Smith Manoeuvre checking account to pay for the expenses of your rental property. Your revenue comes in and your expenses are going out. You're drawing off your Smith Manoeuvre checking account to pay for these expenses. But the revenue coming in from the property is flowed through. Now, it doesn't have to go through your personal checking account. It doesn't really matter with what you do with the revenue. What's important is it hits your mortgage. Because it hits your mortgage, 100% of it, because it's prepayment, goes to paying off the mortgage debt. Then the room increases on your HELOC. Then you reborrow it. Then you pay for the rental property expenses. What you have to be careful with cash damming, though, is that you're taking your rent and you're paying your mortgage with it. You need to make sure that you're confident that you're going to have room on your HELOC to pay for your mortgage expenses on the rental property. As an example, it's your first month with your readvanceable mortgage. You go do all the cash damming stuff, and you've never actually used the product before. And maybe it's not set up correctly. Maybe you didn't know. I'll give an example. Scotiabank has a 40 to 60 day delay generally on the readvancing happening. Once you're 3 or 4 months in the strategy, it makes no difference. If it's month one and you go do this and you don't know this, well, your rent is not showing up for 40 to 60 days to pay your mortgage payment. It's probably going to be a pretty stressful day and a bit of a 911 for you. So this is the reason why there's professionals involved, because even if you have the right product or the right bank, it can be set up incorrectly. And even if you have the right product and the right bank, you may not know how it works. As always, my promise to all of you is that I don't sugarcoat things, and I wanted to go through all of the risks with you guys. The first thing is interest rates rising. I think we're all familiar with this, but as interest rates rise, the cost of borrowing on our mortgage, long term at least, depending on if we're in a fixed or variable, goes up. More importantly, the cost of borrowing on our home equity line of credit goes up as well. As long as our mortgage, our non-tax deductible mortgage and our HELOC costs or home equity line of credit for investing costs go up equally, so in other words, they're both floating rates, we can generally make the baseline assumption the Smith maneuver is good, even in a rising rate environment, as non-tax deductible debt cost is increasing, which increases the overall cost because you have to pay tax on all that interest you pay. By moving it over to a tax deductible debt, even if the cost is higher overall, it can still be beneficial for you as you're now avoiding paying tax on the interest you're paying because it's tax deductible. The important thing to know, though, is that obviously if your costs go up, you have to be able to carry the payments. And that's where a big part of my role is, and the financial planner's role, is making sure we have a conversation, we go through these risks, and that you have the financial fortitude to get through any potential downfalls. The next thing you have to worry about is your investment risks. If you go invest in WestJet stock because you've heard on the street that that's a great investment and they go bankrupt in 2 months and you've just used the prime and the pump accelerator and invested $200,000, you're going to have a really bad day. That's why it's important that you focus on trying to lower your risk as much as possible rather than maximizing your returns. And it's the reason why I strongly recommend that you work with a good financial planner who understands the strategy, because it is a balancing act. Another common one is the incorrect implementation. If you do the strategy wrong, like as an example with cash damming, you start dumping your rent against the mortgage and it doesn't show up, you can miss mortgage payments. You can run into all sorts of issues. You can get yourself into CRA issue. If you mix tax deductible and non-tax deductible debt, it opens a crack in the door for the CRA to dispute all of your tax deductibility. Job loss is another one that we worry about. You know, if your job is to press the button on the machine and that machine disappears and therefore the button pressing job disappears and all of a sudden you're trying to find a new industry at 50, it can obviously disrupt this. And because we're using a higher degree of leverage compared to the scenario where you pay off your mortgage, there's a risk there. If you started the strategy 20 years before and you've got $500,000 of debt and you've created $1 million of investments, you're probably better off having done the Smith maneuver than not. But if you're 3 years in the strategy and your investments haven't had time to grow, it can be quite risky. Another one is the CRA rule change. Even in the Fraser Smith book, there's mentions of the CRA wanting to change the rules or the possibility of it. And there's actually an argument of why the Smith maneuver would make sense, even if the reborrowing wasn't tax deductible. And there's math behind it in the book that shows that it would make sense. I stay neutral on the topic, but at the end of the day, it's important to know that for the last 20 years, there's been rumblings about CRA rule changes. Hasn't happened in 20 years. I personally don't think it's going to happen, but it's always a possibility. The next one, and this is something that your broker should be talking to you about, is demand loan. When you get a readvancing mortgage, your home equity line of credit's a demand loan. In a 2008 style financial crash, as an example, in the US, it was not uncommon that home equity line of credits were called. In Canada, what happened more likely was they trimmed the available room away and they stopped any increasing. But it's possible that the lender can increase the interest rate on your home equity line of credit. They can reduce the limit, or in a worst case scenario, they can say, hey, you've got 30 days to pay us back. It's a bad scenario. It's pretty unlikely, but it's something that you should know is possible. One of the most common threats I see to the strategy is divorce. All of the debt, all of the tax deductible debts and everything are tied to the home. If the household splits and they're splitting the investments, it can get really tricky for whose debt is where. And if the home is sold, it could force the strategy being unwound. And I would say the last piece is stress. if investing is stressful for you, if debt is stressful, if these things are going to worry you, I think there's one of two routes you can go. One is just don't do the strategy. And I think that's totally reasonable. It's not right for everyone, and it's a very real concern. And if it's going to bother you, I suggest you don't do it. If you're unsure, I suggest you dip a toe and implement the strategy very gradually. Because if you've done $5,000 of borrowing and investing, it's pretty easy to unwind and the financial damage won't be significant. The other option, though, is to really make sure you find a good professional team that you trust and let them do most of it for you. They're actually financial planners that will implement the whole strategy for you. You just need to sometimes transfer the money. And I've seen situations where even they do that for you. Once a year, you check in on it. They give you a report. You talk to your accountant, and then you forget about it. You delete your Yahoo Finance app. You don't look at anything stock market related. And you know this is a 20-year strategy. You have professionals who will call you if there's an emergency, which is pretty unlikely. And otherwise, you let the strategy run. The professionals handle it. In 20 years, you reap the benefits. So that's me 12 years ago. I know I've aged. I went skydiving. I did 2 solo jumps. The first jump, you have to hang off the wing of a plane, little scary looking Cessna thing. The wing comes out and there's a strut. And you actually have to grab this strut. You've never gone before, kick your feet out of the plane and just hang there, kind of like Superman. And then you have to look over at your instructor, look back. You do that 3 times. Then you let go. I did that twice. I did the first one, which is 3,500 feet, and I did a second jump from 12,000 feet. The reason I wanted to share this with you is I'm here talking to you, and I have thrown myself out of a perfectly good plane twice. Now, without the right training, preparation, the right people with me, I promise you that if you throw yourself out of a plane, you will die. But with the right people, preparation, and training and equipment, you can take dangerous things and reduce the danger level to a manageable level, to the point that hundreds of thousands of people go skydiving every year. 99.9 or whatever percentage it is are perfectly okay. The Smith maneuver is no different. If you do it incorrectly, pretty good chance that you're going to get yourself into trouble. If you do it with the right people and the right professionals, I'm not going to sit here and tell you it's risk-free, but you can minimize the risks to a very small level. And it's going to be your job to work with those professionals to figure out what the risk is for you. And if it's acceptable, you can take risks and work with people to reduce them down to an acceptable level. If you think the Smith maneuver is right for you, the first thing you need to do is make sure you've got the right mortgage. That's typically where I come in. Along with that process, we're going to do a general education of the strategy, like a lot of you guys have tagged along for. We're going to have a lot of conversation about what your worries are, your reasons, your why. And my goal is not only to make sure you've got the right mortgage product, it's to give you my opinion if the strategy is a good fit for you. But most importantly, make sure you're working with other professionals, and I can introduce you to anyone that you need, and to help arm you with questions so you can go to them. So you can go ask your financial planner, your accountant, or your lawyer good question. Instead of saying, is the Smith maneuver good for me? You can go and say, hey, I'm 45. I have a pension fund. I'm worried that I'm only going to have about $50,000 a year to live on in retirement. I've got 20 years till I want to retire. If I implement the Smith maneuver, how will this impact my retirement, and what are the risks and how can I manage them? The last piece is connecting with the financial planner and the accountant. There isn't really a first or a second. It depends on your situation and what challenges come up first. If you've got a spouse or you've got co-ownership on your property or any type of tax issues that kick up, I generally suggest we do the accountant first. Whereas the flip side is that if your situation is relatively simple from a tax perspective, but you're worried about the investing, is it a right fit for you? Then we go to the financial planner. But there is no right or wrong step, but it is important you do both. One of the most common questions I get is, what paperwork do I need to keep if I use or implement the Smith maneuver? So the first thing you need to keep your home equity line of credit. Your mortgage statement itself is not that important because it's non-tax deductible debt. Might be useful for tracking purposes, but from a perspective of actually using the Smith maneuver, doesn't matter so much. Your home equity line of credit statement is critical. You must have this document. You must save it every month. And personally, I suggest you keep it in at least 2 places. Maybe it's a thumb drive or a portable hard drive. Maybe it's a computer, but you should also have it on some sort of secure cloud just in case something happens, because this is going to show your tax deductible borrowing. This is going to show the source of the interest that you're going to use as deductions. The next thing is the Smith maneuver checking account. This is kind of the crossroads where the money's borrowed from the line of credit and then either goes to investing or goes back to servicing that tax deductible debt. It's what links the debt to the tax deductible purpose. The last piece is the investment accounts. Wherever the money actually goes to be invested, you need to keep the statements to show that it went into an S&P 500 index fund or whatever it may be. That way the CRA can see a clear line from your home equity line of credit to your Smith Manoeuvre checking account to your investments. The reason that I suggest that you keep everything like this is if they do ask for these documents, if you use the strategy correctly, they will see only this. They will not see your Netflix account. They will not see the restaurant you went to. They will not see money from grandma, whatever it may be. And the reason this is important is by keeping this as an isolated unit, there's no chance that wrong money comes in and moves out and they go, well, hang on a sec. You took $2,000 out and used it to pay your mortgage payment. That's not tax deductible. And you go, oh, well, hang on a sec. It came from my uncle. It was a wedding gift. Well, what if they say, well, no, we think that you used the wedding gift to invest and we think you used the borrowed money to pay your mortgage. All of a sudden, you've opened up Pandora's box. And if you have an auditor that doesn't like you, they can make your life really difficult and potentially unwind your tax deductibility. So it's really, really important that you treat this like it's sacred and you follow these steps to a T and you do not have any oopses. You do not mix the money up. The next thing you want to do is at a minimum, once a year, you're going to want to assess the strategy. Speak with your chartered professional accountant, speak with your financial planner, make sure everything's on track. Talk about if there's been any changes, any adjustments. I think that at a minimum, that once a year conversation will help you. I would say at a maximum for people that are really worried or have really complex files, 4 times a year. You don't need any more than that. I would say that that's excessive, but a situation where it's very complex and you need a lot of guidance. That's the wrap, everybody, for the quick little spiel on kind of tying everything together. If you need anything, I'm Keaton of Kirkwood and Brennan Mortgage Group. Website's www.kbmortgages, and this is my cell number. So if anything's ever urgent, if you ever find yourself in trouble, even if we've never spoken before, at the end of the day, if you think I can help you, I'll take your call and I'll do my best.